Major U.S. averages were little changed Wednesday after the Fed stuck to its highly accommodative stance. Now, Mark, the S&P 500 and the Dow, they were trading near very significant technical levels. Do you see them breaking through these levels anytime soon?
No, I think the averages have gotten up to levels where we really need to consolidate recent gains. We've had a very good run, but there are a few things of concern. Specifically, indices have gotten overbought in recent weeks. We've had a 10-week rally from November. 1500 is a very major area for the S&P, right up between 1500 and 1510. Indices are starting to reflect counter-trend signals of upside exhaustion, which are basically counter-trend signals. Some technicians use trend following, some use counter-trend. These are signals that suggest at least we should have some sort of pause, at least in this rally. You've been seeing increasing signs of momentum divergence. That's another concern. That's over the last couple of years. Indices go higher and higher, but yet momentum continues to lag, and volume obviously has been a big concern too. Now we're at levels where the AAII and different sentiment polls are showing nearly a 30% spread between bulls and bears, and so historically those have been times when indices have made at least minor corrections in price. So those are a few concerns. There are some good things. Obviously the Dow is right close to all-time highs on a closing basis with 2 days to go, tomorrow being the final day of the month. The Dow has the potential, being over 13,930 on a closing basis, to make new all-time monthly closing highs, which would be to some extent something to mention. We're also about to close out the month of January, and as we all know, the monthly effect when January is positive typically is an 83% chance over the last 50 years that the year can be positive. So that's also something to mention. It'll also pay to look at the sectors which outperform in January as being ones to potentially favor for New Year. But we heard a little bit about the Fed today. The meeting was basically a non-event, but there was concern when they say a slowdown or a pause in economic activity, right? And so you've seen interest rates now above 2%. I think that's going to be short-term in nature. I don't think that we can remain too much above 2%. If anything, in the next few days, that would be an opportunity to buy treasuries if we get up near 2.07, and I think that we're probably going to start to rally in treasuries, which would coincide with a bigger pullback in equities. But it's only, in my thinking, a short-term pullback. I don't see a larger top at this point, so I think it's going to pull back probably until the middle part of February, which would mean 14 to 14.16 in the S&P futures, and that should be a time to at least step in and think we can bottom out. At current levels, though, I don't see indices making too much further progress on the upside. Specifically today, the U.S. dollar index is starting to really break down below support, and that's had a big effect on precious metals and the grains. We're seeing big moves in gold. We really need to get above 1710 to think a bigger move in gold can happen, but it is at least a short-term positive for a lot of the precious metals. So those are a few thoughts.
And also, what are you expecting of market movement tomorrow in light of the build-up to the big non-farm payrolls report Friday? We've got a couple of different employment numbers out tomorrow. We've also got manufacturing data and income and spending reports that will be coming out tomorrow as well.
I think today was a big eye-opener. If you look at GDP and seeing a negative print, and that was a big shock to a lot of people, and they're pumping $85 billion a month in the economy and buying mortgage-backed securities and treasuries, but yet unemployment is still elevated, and you're still seeing now signs of negative growth. And so I'm not certain that tomorrow's economic numbers are going to have any big detail. My thinking is that, technicals tend to move the market. They move earnings. Economic indicators respond after the market's already moved. We've seen a big move up in the market now, and earnings have risen. Now we're seeing decelerating earnings. So the Russell being at new 5-day lows, the Russell 2000, has the effect often of leading the broader market lower. So my thinking is that we can see a little bit of a correction, and that's what we've been telling clients as well.
And also, in light of all the big headlines on Apple and Amazon, the BlackBerry news, as well as Facebook reporting earnings after the close, what are your charts telling you right now about the tech sector?
Well, it's probably still a little bit early to be super bullish on tech. We've seen almost a 6-month relative correction versus the broader market. Tech has been the one sector that hasn't performed. I think now a lot of these stocks are getting down to levels where they probably will start to bottom out, and Apple being one of them. But it's tough to be too bullish on tech. But I think that overall, though, it's a better risk-reward going forward than some of the other sectors, such as financials and industrials and even materials in the near term that have gotten very stretched. So, you have to be selective in the market at this stage with things starting to roll over a little bit. Facebook has obviously had a very good run in recent weeks. a lot of tech hardware stocks have also bounced, and some of these stocks are showing signs of rolling over. So it's good to be selective.
Thanks, Mark. This is Andrea Say reporting for The Street.